Good morning, good afternoon, good evening, wherever you are. Welcome to the Money Game, where we use facts and numbers and a little bit of imagination to make actionable predictions about the big stories shaping the world today. Yes, we don't do small on this program. Big is beautiful. My name is David Wu, a former Wall Street macro strategist and the founder of David Wu Unbound. As some of you know, I started my career as an economist at the IMF. You know the IMF as the International Monetary Fund, but what you may not know is that in many parts of the world, the IMF stands for I am fucked. This is because the IMF runs the world's ER, and countries only go to it when they have absolutely no choice, when they're in serious trouble. Macro investing is the same. It loves troubles, crises, conflicts, wars. God knows we have a lot of those right now. Indeed, I think macro investing has not been more exciting in 10 years. Indeed, this week alone, 2 subscribers to this blog separately told me they're each launching a new macro hedge fund. Great timing. So what are the big macro stories right now that people are talking about? What else? COVID, and Afghanistan. In this week's program, I want to share with you an analysis I did that led me to conclude that the US may be in a worse shape vis-a-vis COVID than I previously thought. Too bad. This has weakened my confidence that rates will be heading higher in the very short term. Regarding Afghanistan, many commentators have been comparing it with Saigon 1975. I actually think that Tehran 1979 may be a much more apt comparison. In my view, Afghanistan, at least over the next 4 weeks, poses a major tail risk, and I think there's a time to park some cash on the sideline. Before we get to my analysis, let's do a quick market recap of what happened last week. The bottom fell of the stock market last week. We saw aggressive selling across the board around the world. Europe, Japan, Canada were down somewhere between 3 to 4%. China was down as much as 8%, followed by Brazil by down 6%. Even the US, which has been so resilient to correction lately, was down almost 1%. What's going on? In the US, the cyclically sensitive sectors got hit particularly hard. Financials, industrials, all were down 2 to 3%. But the material sector, especially energy, got absolutely crushed. The only sectors that managed to squeeze some gains are utility and defensive sector like tech. The only assets that did well, predictably, were the safe havens, such as gold and US government bonds. These assets did well, but they didn't do that well. Certainly not well enough for me to think that we've seen a capitulation in risky assets, that it was time for us to basically start bottom fishing. In fact, if you look at my proprietary risk sentiment index, it's only gone back to neutral. Sure, the market probably is no longer complacent as it was a few weeks ago, but certainly the market has not yet panicked. If technicals are not giving us much to chew on, what about fundamentals? Well, was the correction last week to begin with justified? Well, in case you don't know, the trigger for the correction were 2 sets of numbers coming out of the US and China, the 2 biggest economies in the world right now. In both instances, retail sales slow last month more than expected. As you can see on this slide, both peak around the same time. Both have been coming down over the last 2 or 3 months. What is weighing on investors' mind is whether the slowdown over the last 2 or 3 months, especially last month, is it the beginning of a bigger slowdown ahead. More specifically, investors are asking themselves whether the upward march of COVID cases in the US is starting to hurt consumers and pushing them to stay at home. Likewise, in the case of China, having seen a big jump in COVID cases last month, which basically led to lockdown in a number of large Chinese cities and ports, investors are asking whether Beijing is going to be able to have everything under control vis-a-vis a much more virulent Delta. To answer this question, I decided to do a deep dive into the cross-country COVID numbers. I was surprised by what I found. In fact, I did not particularly like the implications of my finding because they are at odds with my prior view. But I guess I have no choice but to accept the results, as I don't argue with numbers. I started out with the assumption that countries with high vaccination rates should be experiencing less severe COVID outbreak. However, at first glance, the data did not support my hypothesis. Let me explain what I mean. On this slide, I have ranked all 38 OECD countries according to the share of population that's fully vaccinated. What you see here is that 4 out of the 10 countries with the highest vaccination rates, Iceland, Ireland, France, and UK, are among actually countries currently with the highest number of new COVID cases relative to their population. I thought, what the hell is going on here? Then I looked at the relationship between social distancing rules and new cases. What you can see here on this slide is that 3 out of the 10 countries with the most stringent policy response, according to the Oxford University right now, are currently among the countries with the highest number of cases per million people. This is a little surprising too, but let's just say this is due to reverse causality. In other words, that countries that are witnessing more severe outbreak are forced to adopt more stringent responses. When I ran a simple correlation between the number of new cases per million people and the share of population that's fully vaccinated, guess what? I got a positive correlation of almost 30%. I asked myself, how does one explain that? I decided to ask myself a different question. What do countries currently experiencing the most severe COVID outbreak have in common? As you can see on this slide, the 3 countries with the highest number of average new daily cases per million people are Israel, UK, and the US. Well, it so happens that I'm a US citizen, a UK citizen, and a legal resident of Israel right now. Besides the fact that these 3 countries are all very close to my heart, what else do they have in common? Well, let me tell you. They were the first out of the gate when the vaccines became available. They were faster at acquiring the vaccines and administering them than any other OECD countries. As you can see on this slide, already 3 months ago, Israel had completed vaccinating 59% of its population, the US 37%, and UK 31%, which was all significantly higher than the rest of the world, at least among the developed Western nations. The question I started to ask myself is, being the first, is it putting them at a disadvantage to the extent that they're also now the first to see the effect of the vaccine wearing off? So my new assumption was that more recent vaccination was likely to be a better predictor of new COVID cases today than total vaccinations are. And guess what? My gut feeling turned out to be correct. When I plotted, the number of new COVID cases per million people against share of population that became fully vaccinated over the last 3 months, a sort of nice negative relationship emerged, as one might expect. Moreover, Israel now makes sense in terms of where it is. Yeah, it is true that it's got very, very high number of new cases per million people right now, but then again, less than 10% of Israelis received their full vaccination basically over the last 3 months. So is the case for the US. I mean, it's interesting because less than 15% of the Americans received their full vaccination basically the last 3 months, and that's consistent more or less with the fact that, you know what, it's experiencing about 400 basically cases per million people at the moment. So far so good. Then I decided to run a very simple model for predicting new COVID cases. A simple linear regression model that looks at the relationship between new average daily COVID cases per million people and the share of population that became vaccinated over the last 3 months, and the stringency of policy response as of June 20th, because I decided to look at this retroactively 2 months ago. For this exercise, I dropped 8 countries whose new average daily cases per million are below 50. This still gives me a sample of 30 OECD countries. And what are the regression results telling me? Number one, an increase of 10 percentage points in terms of share of population fully vaccinated reduces the average daily new cases by 33 per million people. That's a big number. An increase of 10 in terms of policy stringency has about the same effect. And I get an R square about 25%. When I drop countries like Mexico, Colombia, Costa Rica from the model, it improves the regression results even more. For those of you who are not technically minded, what does this all mean? Vaccination is a more effective and less costly way to contain the pandemic than lockdowns. However, the drawback of vaccination is that this effect wears out over time. In the case of Israel, US, and the UK, being the first also means that they're the first to see the effect wearing out. This is the reason why the race for the third booster shot is now definitely on. A recent study done by an Israeli HMO, Maccabi, suggests that a third booster shot is 86% effective against Delta. There's no doubt the race for the third booster shot is on. So far, Israel seems to be leading the race. As of last week, the Israeli government has completed administering more than 1 million third booster shots to its population. Starting next week, they're going to start to already the outreach programs for third booster shot, basically for people under the age of 40. In the case of the UK, Boris Johnson government has announced that starting in September, they're going to complete, giving third booster shots to over 32 million UK citizens. I think the UK is in a pretty good shape. What about the US? The US seems to be completely behind the curve, and this is extremely worrying. The Biden administration announced last week they're only going to start administering the third booster shot starting on September 20th. This is worrying because, as I said before, right now, less than 15% of Americans were vaccinated over the last 3 months. In other words, many Americans who received their vaccines many months ago are now at risk of catching COVID because the effect of the vaccines having worn off. And the fact that they have to wait another month, this is a pretty dangerous situation, in my humble opinion. What this means for the market, of course, is that most likely the number of new cases will keep going up in the foreseeable future in the US. And this could potentially derail the US recovery. I can no longer ignore that possibility. One consolation is the fact that despite basically the upward march in the number of new cases in the US, the mortality rate remains fairly low, currently around 0.7%. And as you can see on the right-hand side chart on the slide, the number is more or less consistent with the experience of other countries right now. What this, of course, means is that, yes, the vaccines, may no longer be effective after certain months, but they're still pretty effective against deaths and possibly severe illness. What is very clear is that even if people don't get sick, people are becoming more cautious. As you can see here, the open table seated diners, basically numbers suggest that over the last 3 weeks, there continues to be continued loss of momentum in terms of Americans wanting to dine out. And as I said a couple of weeks ago, given that the leisure hospitality sector has been the biggest engine of job growth over the last 3 months, that this loss of momentum in dining out could potentially have big impact on job growth over the next 2 months that might cause the Fed to sit on their hands a little bit longer. One thing I'm more confident than ever is my belief that US rates can only move higher once the number of new COVID cases having peaked. Now let's turn to Afghanistan. This is a slide from my podcast last week. I maintain my view that the manner of the American pullout from Afghanistan is a huge mistake, and that consequences are already playing out in real time. And I have no doubt that over the coming weeks and months, the Middle East in particular will become a messier and a more dangerous and risky place. I also told you last week that I thought that Europe might end up paying the dearest price for Biden's folly, as millions of refugees from Afghanistan basically start to make their way to Europe. I reminded you that the 2015 European refugee crisis, the result of the civil war in Syria, was probably the single most important reason for the outcome of the Brexit vote. There's no doubt in my mind that Europe cannot afford basically a replay of the 2015 crisis, especially as Merkel exits from the political scene in Germany in the coming election. Making prediction is also about knowing which is the most relevant historical example. Many commentators over the last week has been comparing Afghanistan 2021 with Saigon 1975. In my view, the danger, of course, is that Afghanistan turns out to be a lot more like Tehran in 1979. Let's review the timeline of what happened in 79 briefly. In February that year, a guerrilla group basically tried to seize the US embassy, but managed to only hold it for a few hours. But in November that year, a group of students tried it again, and this time they succeeded. And moreover, they were able to quickly gain the support of Khomeini. As a result, 52 American hostages were kept in captivity for 444 days. President Carter, of course, tried to send a famous, rescue mission that ultimately failed, that only basically brought more humiliation to the Americans in the region and arguably basically, reduced the chance of Carter being reelected in the election basically that came a year later. In many ways, I would argue that Afghanistan right now could potentially be even worse than basically Iran in 1979. Think about it this way, right? A few thousand Americans still remain in Afghanistan. And guess what? They're scattered across the country. And in case you haven't heard, the US military has already urged Americans against, traveling to the Kabul airport because of threats from ISIS. Moreover, Biden has also even promised to essentially bring out potentially tens of thousands of Afghans that are currently employed by the Americans. In addition to ISIS, there are also radical Taliban factions that may not answer to the central leadership of the Taliban that might decide to basically take matters into their own hands. And I think from that point of view, it's a fire keg to the extent that literally all it takes is a small incident, and that incident can potentially blow up. There are also other similarities between today and 1979. In 1979, guess what? The big story was inflation. And the Fed was sending out ever more hawkish message. And as a result, even before basically the Iranian hostage crisis, S&P 500 had a 10% correction. And that set the stage for basically increased market volatility in the coming months. Biden's approval rating was already slipping before the Afghan crisis. With the crisis, it's now broken decisively below 50. And it looks like it's going lower from here. What does this mean? Given the tremendous polarization within Washington, a weak Biden means there is going to be even more difficult to bring the different sides together, whether it is the progressive Democrats and the moderate Democrats, or the Republicans and the Democrats, and so on and so forth. This means that less is going to get done. This certainly, basically, in my view, reduced the probability of another fiscal stimulus being basically pushed through the pipeline. In other words, that actually Afghanistan ultimately might actually bring some fiscal sanity back to Washington, which is not a bad thing in my view. I'm always looking for, of course, the silver lining. On that note, Talk to you next week.